what I find interesting here, and you and I have touched on this, is the stock market was making an all-time high back in 2007. Gold, the yellow line, was pushing up to all-time highs. And then finally, we started to see the stock market struggle a little bit. Gold started to pull back. I kind of believe we're in a similar situation in terms of price action. We've got gold pulling back. There's a little bit of fear in the market, very similar to what we saw just over here in 2007. And what's interesting is if we look on the left chart, I've layered in multiple different. Yeah, I think it is a combination of things. Obviously, the jobs number is a little negative. I think the two banks coming out, kind of two of the biggest banks, kind of when it comes to people giving analysis from those banks, they were bearish. So people listen. Although you got to take it with a grain of salt. It's, pretty high level stuff. A 10% pullback over the next 2 years is not a whole lot to go off of. We kind of have that we have a 10% correction every year, if not larger. So I think the markets are a little frothy. When we look at the charts over the past couple of weeks, really, we saw a big pop. We saw a couple big gaps up on the NASDAQ. We saw the Magnificent Seven breakout. We've seen the stock market really have some. I'm not a big fan of price charts when they have gaps. So if I was to share my chart here, I'll show you what I'm seeing here. Now, if we take a look at the SPY, and this is the same with the NASDAQ, we had resistance through here, and the market loves to gap above or below resistance levels or support levels. So it gapped above it, and we've got this gap window. Then we had another big move higher as it broke out. I think a lot of people were watching it. They jumped in. And it's created this momentum, and gaps tend to get filled in the market, David. And so the market has come down, and now it's trying to fill this previous gap and test this breakout level from about a week and a half ago. So this is a perfectly normal move in terms of how the market unfolds. We saw a pullback, we saw a little bit of a bounce, and now it's pulling back into support. The thing is, people today are actually really nervous. This is Tuesday as we're speaking here. We actually have some panic selling in the stock market. It's not like a huge sell-off, but our indicator here, when we look at the stock market tools that I use, we actually have some panic selling going on in the market. So I have this panic selling indicator in this top, this green indicator here. Typically when it gets over these levels and this blue line, we usually see the market put in a low. So we had panic levels hit over here. We had panic this morning at the open as we were talking. We're starting to get back into a panic territory. Typically after that, we see the market kind of rebound. The other thing from a short-term analysis is we have these lime green bars. And if we were to zoom back on the chart, lime green bars are typically seen as an oversold market condition. It means the market's sold too quickly to the downside, and usually bargain hunters come and step back in. So the pullback that we're seeing is completely controlled. It's very normal. Yet for some reason, investors are panicking today. They're dumping shares. That's what this indicator tells us. On the New York Stock Exchange, there's 3 people hitting the sell button to every one person hitting the buy button, meaning people are dumping shares on the bid. They don't care what price they get out. They just want out. And when 3 people are running for the door to every one person who's waiting to buy, that tells us there's short-term sentiment shift. So really, the markets still are in an uptrend. This is nothing more at this point than just a pullback, and we're just kind of letting the markets kind of correct after this.
Behind the chaos, data tells a clearer story. Panic selling indicators show that sellers currently outnumber buyers 3-to-1 on major U.S. exchanges. This type of imbalance often marks a short-term market bottom, where fear overrules rational strategy. Indicators that track rapid overselling, such as extreme volume ratios and momentum reversals, suggest the decline may already be near exhaustion. Historically, these fear-driven waves become prime opportunities for disciplined traders who buy when the crowd rushes for the exits. The stock market remains in a broader uptrend, and what appears alarming to many is technically a controlled corrective pullback.
Yeah, so the way I define panic is more or less, it's taking the New York Stock Exchange volume, the up volume and the down volume. It's just a ratio. You divide them into each other. And more or less, it's telling us, so I use the New York Stock Exchange volume because it's known as the big board. The big brands are in there. If you were to go ask an average investor, pick a stock, it's probably in the New York Stock Exchange. And so I use that volume as that mass psychology. When we see everyone selling shares on the bid, they're just market order, get me out on the New York Stock Exchange. That's usually telling us the general public now has reached a tipping point where they just want to get out of their trades. They think everything's falling apart. And it's the same. We have one for the FOMO indicator as well. The markets can rally. and the market can actually have everybody running in and buying stocks, and they don't care what price they pay. And that's the red indicator that I share on my chart when you and I do this. So it tells us when the market is, these extreme of short-term overbought, oversold levels and the panic selling and FOMO, they're just short-term extremes in market sentiment. And they give us an idea. Like today, for example, while most people are panicking and selling stocks, we look at it as, hey, the S&P 500 has pulled back to the 20-day moving average. It's had a nice three-wave correction, or a little bear flag, down to support. It's testing the breakout. It's a gap to the downside, and there's panic selling. And all these things actually say, while everyone's panicking, we're like, oh, this is nice. This is actually like kind of a buy the dip mentality. If you're a momentum trader, this is where you'd step in and look for kind of, you buy the dip and you sell the rip. So we could see a big pop and rally over the next 1 or 2 or 3 sessions and create this momentum. So that's how that indicator is done. It's just pure volume flow on the New York Stock Exchange.
When uncertainty rises, investors behave like a single organism. Instead of rotating into safer assets, they often liquidate everything at once. Even sectors that typically benefit during downturns, like commodities and mining shares. Nearly every major sector has been dragged lower recently, confirming broad-based fear rather than logical repositioning. Tax worries and misinformation only amplify hesitation, creating resistance to tactical repositioning. But successful strategy isn't about clinging to assets through painful declines. It's about protecting capital during downturns and participating when markets recover. Fear is expensive, especially for those who sell at the worst moment.
But when we look at sectors as a whole, like here's about 40 different sectors, you can see most sectors are down today, and they're all down pretty much 1% or much higher. As you said, David, I believe it is a little bit of a broad market sell-off. People are nervous, and when people get nervous, they tend to liquidate everything. And even if it's something that should be in favor, like precious metals or miners, they just tend to sell everything. And this is a good sign. This is generally telling us that this is kind of a tipping point. Once the masses kind of release their shares into the wild, into just they exit, usually the market wants to turn around. And the amount of sectors on our hot list here, they're pretty much all negative. We have a large group of them with all kinds of short-term downtrends. I think we're going to start to see this market kind of carve out a bit of a bottom and try and figure out a rally. I think the stock market is in for a rough ride. I think gold and silver are primed for kind of to benefit the most over the next month or two. Seasonality wise, when we look at the markets, if we look for the stock market here, typically from the beginning of November to the middle of November, the stock market struggles a little bit. So that's right where we are. We actually saw the market push higher going into November, and now it's starting to pull back. If you look on the chart, we had a run up into November, and now it's starting to pull back. So seasonality seems to have its claws into the stock market. If we look at gold, it's kind of the same. Gold kind of holds its ground and struggles, and then of course it still has more pressure into the middle of November. So I still think we're going to see a little bit of profit taking, a little bit of panic selling for the next more so 10 days or so, 7 to 10 days. And then we're going to have a tailwind behind us for the precious metal space and the stock market as we go into that holiday end of year rally.
Look at these comments on our last interview. I love reading through the comments. We had you on October 21st, so that's the date gold dropped 6%. We were talking about comparing now to 2008, which we'll talk about in more detail today, by the way. And people should check out Chris's last calls just to keep tabs on what we've been saying. He comes on regularly on the show. Anyway, Chris again here. This guy is the Canadian Jim Cramer. I don't know what that means. You are the Canadian clown. Okay, is that your alt account? Is that one of your burner accounts? Dude has called 84 of the last 0 drawdowns. Gold is still above 4K, pretty good. 100% cash. This guy is paying tax like crazy every time he sells. Now that's interesting. We can talk about that. This is not applicable to the average investor who should not be paying 25% tax on any gains every week or a few months. What's he referring to?
Well, I mean, if you trade like say the QQQ in and out all year, at the end, it's not like you pay 25% tax on every single gain on every trade. If you have say 10 trades in the QQQ and you have a net profit at the end, whatever the net profit is, you do have to pay tax on it. It's not that you pay that on every single trade. So it's at the end of the year, are you net profit, like a net profit or loss for your investing, and then you pay tax on that. So it's not on every trade. That's just, I think that's just confusion there. And of course, this is where I see things differently, right? People don't want to pay tax. The reality is, if you pay tax, you are making money. And one of the biggest, there's two big taxes here that most people don't seem to grasp or take into account. One of them is, you could go after a bear market, you could go 5 to 10 years or longer with no returns. The tax there is time. You're literally wasting potential returns. You're wasting time, which is the most valuable resource we have. The second is, if we go into a bear market and your account falls 30 to 50%, especially if you panic out of it, you just paid a way bigger tax than 25%. So I would much rather navigate the markets, pay taxes on gains. I don't hold things as they collapse or fall. The focus is to really focus on holding things going up or moving to cash and earning interest on the sidelines while the market falls apart. So that's kind of the way I see the whole tax side of things.
There's an eerie resemblance between today's environment and the months before the 2008 financial crisis. Back then, stocks peaked while gold quietly gained strength. As equities faltered, capital spilled into precious metals, setting the stage for a historic gold rally. Today, gold briefly overheated as investors rushed in, causing a temporary pullback, just as emotional waves hit miners and silver. Yet momentum into hard assets remains strong. Investors seeking protection from inflation, geopolitical instability, and recession risk continue accumulating physical metals. If history rhymes, precious metals may soon accelerate while stocks face a turbulent final chapter.
What I find interesting here, and you and I have touched on this, is the stock market was making an all-time high back in 2007. Gold, the yellow line, was pushing up to all-time highs. And then finally, we started to see the stock market struggle a little bit. Gold started to pull back. I kind of believe we're in a similar situation in terms of price action. We've got gold pulling back. There's a little bit of fear in the market, very similar to what we saw just over here in 2007. And what's interesting is, if we look on the left chart, I've layered in multiple different assets down below. So we have GDX, which is gold miners. We got silver, platinum, and palladium. And this is what I've been talking about for the last little while, is everyone's been piling into gold. It became a short-term crowded play, which is why we've got this initial little pullback. But you can see that in this chart. When we look at what people have been doing with gold miners, with silver, with platinum and palladium, money's been moving into this space. So whoever's open to the concept of holding physical metals, they have been piling in. It's been a little bit of a feeding frenzy. Things got a little overbought. When we look at what happens after this, we tend to see the yellow line, gold, shoot dramatically higher, rallies about 30%. The stock market ends up struggling. So I think money pulls out of stocks. Money's always looking for a return. So it's going to move to whatever's got momentum, which is gold. It's also going to be miners, it's going to be silver, platinum, and palladium. So that's kind of where I think we are right now. If we look on the similar chart of where we are, you can see, if I was to just kind of move 2007 back, we're in a very similar situation. All of these assets have come to life. It's become the crowded play. We're having the first little pullback and pause. And then I think we're going to see gold in the precious metal space shoot higher fairly dramatically. I think gold's going to go to 51, 5,200. Silver is going to shoot higher. I think that's kind of where we are. We're right in this cusp of just the last month or two where I think gold and the precious metal space have one more big run. And the big question is, does the stock market stall out, and the money coming out of equities, does that get pushed into precious metals to create this giant rally? So that's what we're just kind of waiting to see.
Short-term weakness often precedes major upside moves. Recent profit-taking aligns with seasonal market cycles. Early November is typically choppy for equities and metals alike. But as the month progresses, markets historically regain strength heading into the year-end rally. Data from gold, silver, and mining ETF flows shows that long-term buyers are quietly positioning as impatient traders exit. When emotional money stampedes out, strong hands take over. Major analysts expect gold could reach record highs, possibly $3,000 plus in the medium term, with some bullish forecasts pushing toward $5,000 if stocks struggle and central banks remain net buyers.
Sometimes they lead, sometimes they don't. Precious metals and miners kind of have this weird relationship to each other at times, and they also can decouple from how they move with the stock market. Sometimes they move with, sometimes they do the opposite. That's what creates a big wild card when it comes to trading the precious metals space. You just don't know if it's going to move with or against the market or the opposite direction. I think gold miners, like we got into this whole kind of little bit of a feeding frenzy phase, same within gold and silver. A lot of people moved in right up into this phase. And so now when you have emotional money moving into the market, when it does reverse, you have emotional money moving out, meaning you usually see everybody pile in at the same time and then they all kind of bail out and sell off. And I think there's a lot of fear in this market. And I think that fear is causing a trickle effect of money flowing out. And gold kind of shows it in a little bit more of a kind of a relaxed way. It's not moving quite as dramatic as the miners, but overall, it's just an unwinding of events. So, for example, gold had hit our measured move right over here. We ended up playing this really nice trade to the upside on this breakout, and then after that, it went into this kind of bubble feeding frenzy mode. And everybody who got out with me on this target, because it was a pure technical trade, that was our target: get in, get out. Everyone had FOMO at this point. Everybody's like, why did we get out? I have to get back in. And tons of people got back into gold because they thought they were missing out and it was going to go to the moon. And now here they are underwater. And now I actually like gold here. And everybody's like, why do we want to get into gold? It's reversed, it's selling off. And so these are these important like turning points. When everybody wants it, you don't really want it. And when nobody wants it, especially when it's in a super bull market like gold right now, that's usually marking a low. So I think gold is trying to find a bottom here. I think we're going to see that happen fairly soon because everybody seems to be bailing on their gold miners. As you said, they're moving out, they're selling off, and they're kind of giving up on it. And I think we'll see a bottom potentially this week in the precious metals space. And miners are down the most because they're kind of this very liquid. They're not very liquid in terms of they sell off. They're a small market, and when people sell them, they drop quickly.
The crowd now questions gold's strength, exactly when opportunity is forming. Gold miners with smaller market caps and greater volatility often fall hardest before surging the most. Early capitulation is typically a signal of an approaching reversal. The key may lie in the coming weeks. Either equities regain momentum or weakness sends cash into safe haven assets. If pressure continues on global markets, precious metals are positioned to benefit dramatically, just as they have during every major financial stress cycle in the past century. Smart investors understand fear creates bargains. Confidence, carefully applied, creates returns.